let's start things off with the broader story of stocks. I mentioned how the S&P 500 has been hitting all-time highs, pulling back a little bit after getting to that 5,100 level. Now, comparisons to Canada, why not? We're talking about a very different North American landscape when you look at the S&P versus the TSX. Certainly, the TSX has had a nice run off its fall lows. And for the year overall, we're looking at a gain of roughly 2%. But in the case of the S&P 500, it's up another 6.5% this year after a 24% surge last year. Our next guest says unless there are more investors interested in sectors like energy, interest in Canadian equities likely could continue to trail. Let's bring in Martin Pelletier, Senior Portfolio Manager for Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks for joining us. Happy Friday. First off, when you look at record highs for the S&P 500, what do you make of that when there's sectors within the broader market that are very much lagging? And I think that sort of feeds into what we were just talking about in the intro, the fact that the TSX is not too far from an all-time high, but certainly has been trailing the benchmark U.S. index.
Yeah, it's the composition of the indices is the primary driver here in passive flow investing. You have the S&P 500, for example, looking at so far quarterly earnings year over year, it's up 2% on earnings and then up 5% on revenue. But when you look at the contributors, you have NVIDIA up obviously 700 to 800% on earnings and some 265% of revenue, and then you got Microsoft in there and Amazon and Meta, and so they're contributing to the broader strength in the S&P. Whereas if you look at the S&P 600, which is the small caps, if you look at year over year earnings, is down 6% in the fourth quarter, and so I think looking at the TSX, we probably see something more flat. And so there just isn't a lot of excitement in those non-tech areas of global markets. And you saw that last year with almost $50 billion of outflow by foreign investors in Canadian stocks. And so that's all working its way into fueling the $2 trillion value of NVIDIA and the $1 trillion megas out there.
It's really interesting. One stat Bloomberg put out today, which I thought was interesting, was with all the NVIDIA excitement yesterday and all-time highs for the S&P 500, there was still just about 73% of the index that was positive, which sounds like a pretty good number, but actually that's pretty low participation for a big up day. Haven't seen anything like that, I think, in more than 3 years' time. So with that backdrop, I guess the broader question is, and this is more of a Canada question, when we've got components that have been trailing big tech, obviously we reference energy coming into this segment. It's up this year. It's up over the last 12 months, but it is trailing the TSX itself over that period of time. What is your sense on what the investor appetite is going to look like for sectors? Let's start with energy, for example.
Well, energy historically has been an area that you go for growth. And with tremendous volatility in commodity prices and the outlook for oil, that growth is, we saw it 2 years ago, and then it's kind of petered out since then. And so, if you're looking for growth, you're not going to find it in probably energy or a lot of sectors within Canada. You're only going to find that within certain subsectors and with maybe in tech. We don't have very much of an exposure there, but in the U.S. definitely. And so if you're looking at investing within Canada, there are some pretty good opportunities. It's just you're not going to get excited about investing in companies that pay 6% dividends. But don't forget, if you're a retired conservative investor, getting a 6% dividend is probably not so bad. If your benchmark is the Magnificent Seven, then that is terrible. But if you're targeting a 6 to 8% rate of return, there are a lot of companies within Canada, energy, financials, and other areas that are offering dividend yields anywhere from 6 to 8%. Telecoms, for example. And so, there's some nice yields there. And then if you get a little bit of growth on top of that dividend, then you're getting closer to your 9 to 10%. And that's a pretty good long-term number. So it's important not to get sidetracked by or enticed by the huge growth that we're seeing in AI, for example, if you're one of those investors.
I'm so glad you brought that up. It is a remarkable stat as you were talking. I was just looking at the magical Bloomberg terminal to see how many dividend yields north of 6% you can get within the TSX. Yeah. And it's upwards of 30 companies, and most of them are very well-known companies. They are in different sectors. When you look at those kinds of yields, do you like to stick with a particular industry group, or are you looking at the companies within different industries and those yields and saying maybe that is a nice way to get paid while we sort of wait to see the story longer term for the broader markets?
Yeah, you want to make sure that those dividends aren't going to get cut, and they have a track record of increasing dividends, and they have the balance sheet to support it. I think that like the telecom space, for example, has been hit and punished, but higher debt levels, maybe some margin compression on competitive pricing, but with those debt levels, debt servicing costs, we think that rates are going to be coming down, and so debt servicing costs will be coming down. So you can buy a Telus or at 6% or a BCE at 8%. Utility sector, Canadian Utilities is yielding 6%. And then in the banks, you're getting anywhere from 5.5% to 6.5%. And, that's pretty interesting as well. Energy, Suncor at 5%, Manulife Financial at 5%. These are all really good blue chip companies in almost like an oligopoly type of structure with protective moats and interest rates coming down. It's not very sexy compared to what's making the headlines out there, but it certainly pays the bills.